Hello, everyone, and welcome to the Money Max account presentation presented by United Financial Freedom. The owners of the company started in the mortgage industry back in 1997 and were listed as one of the fastest growing companies in Utah for a 3-year period. Around 2004, they began to notice a significance with the debt problem in America. Many of their clients were coming back to them just for refinance after refinance to pay off credit card debt, student loan debt, and other debt, pretty much using their homes like an ATM. They realized there had to be a solution to this, and they started seeking those solutions in about 2003, 2004. Around 2004, they came up with a concept and began to develop that concept out. And in 2005, we had the first iteration of the Money Max account program. We did a beta test with 400 homeowners from 2005 to 2006. And to the astonishment and the surprise of the owners, we found that our average client in that 400 homeowner test was about 20% ahead of the schedule that we had given them for debt elimination. Currently, we have over 70,000 clients that have signed up to use the Money Max account program. In 2008, we were awarded national recognition by Ernst & Young for Entrepreneur of the Year in 2008 for financial services in the Utah region. Now, for those of you who do not know who Ernst & Young is, please look them up. They do very intensive due diligence. They look at financials, longevity, retention, product viability, impact on consumers. And this same award, Entrepreneur, has been given out to the icons you see below there, Apple, Starbucks, eBay, and Microsoft. And as well, we've been mentioned in several publications regarding financial services and debt elimination. Disruptive technology is a terminology that we hear thrown around quite a bit lately, and it's an innovative situation that significantly alters the way that consumers, industries, or businesses operate. A disruptive technology sweeps away the systems or habits it replaces because it has attributes that are recognizably superior. Now, if you look at the screen, I am sure that in the last 30 days you all have done business with probably one of these companies that are listed. Well, I'm here to tell you that the Money Max account and United Financial Freedom are disruptive technology for 2020. On our presentation, we're going to look at 8 banking principles today. First is closed-end loans. Second is interest accumulation. Third is mortgage amortization. Fourth is interest cancellation. 5 is open-end credit lines. 6 is float and leverage. 7 is offset accounts. And 8 is strategic debt payoff. Now, I want to let you know that most of what is on the screen right now, you all have probably seen in one place or another, either on a sheet or online or when you've gone to get a loan or your mortgage. What I want you to concentrate in this presentation on is the concept. I don't want you to get hung up on pennies, nickels, and dimes. I want you to grasp the entire concept. No other company has been able to pull all of these strategies together in one system that you can utilize for debt elimination and wealth accumulation. So let's jump right in with closed-end loans. It requires a minimum of full scheduled payment. It allows payment in but no withdrawals. It's driven by an amortization schedule. Any money applied does not affect interest charges until the following month, and it calculates interest charges from the month-end principal balance. What we know about this type of loan is it is too restrictive. We don't have a lot of flexibility, and we pay way too much interest with this type of loan. So let's look at interest accumulation. If I have a principal loan amount, let's say on a home for $200,000, my interest rate is 6%. That'd be a 360-month or 30-year loan. My monthly payment would be $1,199.10. Now, I left the 10 cents off this screen just to keep numbers round, but I'm bringing up the 10 cents because I'm sure I have a CPA or a tax accountant or a math person on the line, and they'll say, well, if he left 10 cents off the monthly payment, what else did he leave out of the presentation? So the monthly payment is $1,199.10. If I make every payment on time, no additional money applied to principal, my repayment is $431,677. That means I borrowed $200,000 in principal, and in interest alone, I'm going to pay back $231,677. So the real cost of our home is $431,677. $677. And to me, I don't know about you, that is just way too much interest. And in any way that I've ever calculated, I cannot see that as a true 6%. We are paying way too much interest on this loan. So let's look at how we can defeat this. Now, many of you are saying, a $200,000 mortgage in 2020, that's just not realistic. But the national average right now is a $200,000 mortgage at 6% interest. But I wanted to give you an example if you were, let's say, on a $300,000 mortgage at 4%. In your first year, you'd be paying 69.26% interest. In year 5, you're paying 63.94% interest. And in year 10, you're paying 55.97% interest. And in year 15, you are still paying 46.24% interest, and there has to be a better way. Let's take a look at interest cancellation here. Now, I want you to look at this amortization table. This is the accurate amortization table for that $200,000 mortgage. And I want to draw your attention to the line that says principal, and I want you to look at September and October. And what I want you to notice there is as we make our scheduled monthly payment, our principal contribution increases by $1. No wonder it takes 30 years to pay this loan off. Now, we are all aware that if we are up to date with our current payment on our primary mortgage, we can send any additional amount to principal that we wish to send and have that money applied to principal. So let's say we made our first payment in the amount of $1,199.10. Now, I want to draw your attention to the principal column. And what if we made that first payment and then we made an additional payment earmarking that to be applied to principal, representing October, November, December, January, and February's principal in the amount of $1,010.54. So we've made our regular payment of $1,199.10. We're going to send in an additional payment of $1,010.54 to be applied to principal only. Well, what I need you to see here is in an amortization schedule, principal and interest are connected. So by prepaying the principal for October, November, December, January, and February, what we do is we cancel the interest for October, November, December, January, and February. That interest cannot come back. That means we save $4,984.96 off the back end of the loan, and we did this for an investment of $1,010.54. So in any other arena, if you were investing, I want to ask you this simple question. Would you invest $1,000 in yourself to get back $4,984? And I think we can all say yes to that question. So let's just take this and up the ante a little bit. Let's say we make that first payment in the amount of $1,199.10, and we were to apply $5,000 to principal, making that first payment in the amount of $6,199.10. Well, we know we have our $200,000 principal loan amount, but by applying that additional money to principal, we now have a balance of $194,800. We are still contracted at 6%. We still have a monthly payment of $1,199.10. But by canceling all of that interest, we actually are advancing the amortization schedule. So moving into our second payment, we are actually making payment 337 on the amortization schedule. That means we eliminated 23 mortgage payments. We were supposed to pay back $231,677 in interest alone. Now we will only pay back $208,373. That's an interest cancellation savings of $23,304. So I guess the question would be now, how many of you would invest $5,000 in yourself to save $23,000? And I think we can all say yes to that as well. Let's look at another type of product that's offered by the lenders, and that would be an open-end credit line. Now, what we learned about that closed-end mortgage is it was just too restrictive. We don't have a lot of flexibility. And I know what I showed you on paper. It looks great. that you can apply $5,000 to principal and save $23,000, but there is a question that arises: where do we come up with that $5,000? And we're going to answer that question for you as well. The open-end credit line has the ability to make multiple payments in and withdrawals. That means there's money in and money out. It uses an interest factor to calculate interest charges. There's no amortization schedule. Money applied today affects the balance today, and it calculates interest based on the daily balance. What we find with an open-end credit line is that this is a much more flexible product from the lender, and we're going to use this open-end credit line as an offset account, which we'll talk about in just a moment, to be able to come up with that $5,000 we need to apply to principal. Now, many of you have heard the concept of float and leverage. I know many of you have a major credit card. You go out on a shopping spree. You spend the money, let's say $500, and you get your credit card bill in the mail. What is it that every one of us tries to do with the balance on our credit card bill when we get it in the mail? And that's right. We try to pay the balance off. And the reason why is if you pay the balance off, you are floating the lender's money, and you are leveraging the lender's money interest-free for 25 to 30 days, depending on the credit card provider. We all know that if we pay that balance off in full, we pay no interest on that money. So what every one of you out there knows is that if we pay the balance off, we pay no interest, so we know how to use the lender's money interest-free. And that could be for a 25 to 30-day period. It wouldn't matter if the credit card was at 2% or at 22%. If we pay the balance off, it is at 0%. So is it possible that we're just thinking too small with our credit card balance? What if we could raise that to a higher scale and use the same concept to eliminate all of our debt? Banks are smart, and they understand the concept of no stagnant money. Smart investors do what banks do. Now, I've broken this down to a very minute concept. I don't want you to get hung up on this. There's a lot more involved in investment, but the basic concept is they move the right amount of money at the right time from one account to another account, and they let it sit for the right length of time. Banks practice sweep account technology, which means when we go to bed, they use our money to earn interest while we sleep. They understand that money works 24 hours a day, 7 days a week, and 365 days a year. It never sleeps. It never calls in sick. It never needs a lunch break. It'll never be an HR problem. It is the best employee you will ever have, but the question you have to ask yourself is your money working for you the best that it possibly can? I think it's all time that we learn how to bank like a bank. Now let's look at this concept of offset accounts and how this applies to debt elimination with the Money Max account program. Offset accounts can be home equity lines of credit, personal lines of credit, commercial lines of credit, secured lines of credit, unsecured lines of credit, credit cards, PayPal, checking and savings account, and yes, some insurance products will function in this capacity. The basic concept of the offset account is you are utilizing an account to offset the interest charges on another account. So we have our $200,000 mortgage, and let's say we have a line of credit with $15,000 available. Now, I said we were going to give you the solution on where does that $5,000 come from to pay down our primary mortgage. Well, now I'm going to say something here that a lot of you are going to disagree with, and it's going to fly in the face of everything you know about finance. What if I told you you could use 10% money to pay off 6% money? Yes, that's right, 10% money to pay off 6% money. And many of you are saying, that's in reverse. It should be 6% money to pay off 10. But what I want you to get out of this is it is not the interest rate. Remember the credit card example. It is the type of product that we are using. So what if we borrowed the $5,000 from our line of credit and paid that $5,000 to our primary mortgage? Well, as you can see, we still basically owe the same $200,000. What I want you to get here is I have moved $5,000 of money from a loan I cannot control, that closed-end mortgage, over to a loan I can control, which is that open-end line of credit. Now watch what happens here. As we know, that cancels $23,304 of interest. That eliminates 23 mortgage payments, so that now puts us on payment 337 on the amortization schedule. But look at what we pay for the use of the money on the line of credit. For a $5,000 balance at 10% on our home equity line of credit, the monthly payment is $50. Now, it's actually $46.77, but I'm just rounding up to make numbers simple here. And I also need you to understand, as we pay down principal on an open-end credit line, the monthly payment or the interest charge goes down as well, but I'm just going to keep it at $50 for our example. Let's say it took you 6 months to pay the $5,000 back to the line of credit. Well, at 6 months, at $50 a month, we would spend $300 in interest on the line of credit to save $23,000 on the mortgage. Sounds like an equitable exchange. But many of you may be saying, well, I couldn't pay that back in a 6-month frame. Okay. Well, let's say it took you 1 year to pay the equity line of credit back the full $5,000. Well, at 1 year at $50 a month, that would be $600 in interest. So how many of you would spend $600 in interest to save $23,000 in interest? Again, I think we believe that is an equitable exchange. Well, let's just make it ridiculous. Let's say it took you all 5 years to pay back the $5,000 to the equity line of credit. Well, if it took you 5 years at $50 a month, that would be $3,000 of interest that you would pay on the equity line of credit to save $23,000 on the mortgage. Still a very equitable exchange. When does that start to look like not a good idea? Well, when the interest charges on the line of credit reach somewhere up about $231,000 of interest, and that's not going to happen in 30 years. Now, what if we take the same concept and we put the credit card in there for float and leverage? Now the way we're going to use this is we're going to say that our client has a $5,000 net paycheck and they spend $4,000 a month. When we get our paycheck, we are going to make a payment to the home equity line of credit for the full $5,000. That means that while that $5,000 is sitting on the home equity line of credit, the lender cannot charge us any interest on that money. Throughout the course of the month, we're going to use our credit card that has Sky Miles and awards points, and we're going to use that for our monthly living expenses of $4,000. That way, our $5,000 can sit on the line of credit for potentially 25 to 30 days out of the month. That means they can't charge us interest. At the end of the month, we're going to get our credit card bill for $4,000 of living expenses. We're going to write one check from our line of credit, pay the balance off in full on our credit card, which means on our credit card, we floated the interest there. We pay no interest. We get our Sky Miles, rewards points, and cash back. And we now have a balance of $4,000 on our home equity line of credit. And then we just repeat the same process over and over again. There is a challenge when someone is trying to pay debt off on their own, not only navigating everything that I've just shown you, but let's say that you had these 6 debts. Which debt would you pay off first? Which debt would you apply money to? Would you apply money to all the debts a little bit at a time, or would you concentrate on one debt? Would you take the debt with the highest interest rate, or would you take the debt with the lowest payment? The reality is that most people, when they're trying to pay off debt, are guessing as to which debt they should concentrate or how they should go about paying off their debt. The reality is, when you're paying off debt, there is a mathematical solution, and with that, there is only one correct mathematical solution. So if you were trying to do something like this on your own, what's missing? Well, no one has the systems to do it themselves. No one has the time to do it on their own. It's too complicated to do manually. It's too complex to navigate on your own. And with all of that having been said, there is no strategic debt payoff. but we have the answer, because technology has finally caught up with personal finance with the first and only financial GPS. Now, with the GPS, when you set up your location that you want to go to and turn it on and start heading on your journey, the GPS leads you to your destination. But now, all of us know that we have made a wrong turn while we're on the GPS, and we hear that little voice come on, and that little voice says recalculating or rerouting. And what I want you to understand there is the GPS is now following you, not leading you. It's following you and correcting your course. Our program tells you how much money to move, the exact dollar amount, when to move it, the exact date, from what account to what account, the most efficient accounts, to help calculate the most strategic mathematical solution to zero out your debt. Looks at every aspect of your personal debt information: amount owed, term of each debt, interest rates, payment amount, income, and expenses. And just like a navigational GPS, when unexpected events occur in your financial journey, like medical bills, car repairs, life happening, yes, your Money Max account program will automatically recalculate your path to zero debt. So let's take a look at this idea of strategic debt payoff and how the Money Max account program handles this. We have our checking account and we have our offset account. We're going to get a paycheck in. The program's going to look at that paycheck and say, all right, let's move a very specific dollar amount as a payment to the offset account, and let's pay the balance down on the offset account. We're going to receive another paycheck. The program is going to analyze that amount of money. It's going to generate another funds transfer and tell us to pay down the balance on our line of credit. Well, the program says at this point, I have exactly the balance that I'm looking for in the line of credit. It's time for me to generate a funds transfer, look at all of the debts individually and simultaneously, and it tells our customer to pay the money here. It gives you the date, what account to take the money from, what account to pay the money to, and a very specific dollar amount. This is all done mathematically. So let's take a look at a sample client, and let's run through a couple months. We're going to use a hypothetical, which is John and Rebecca Jones as a sample client. We're going to say that their monthly living expenses are $2,800 a month. Their primary mortgage is a payment of $1,199.10, leaving them total expenses of $4,000. We're going to say that they make $5,000 of net income per month. And with their living expenses taken out of that net income, they have a discretionary income of roughly $1,000. Now, I want to let you know this is just for example purposes. Our average client that comes on board with us has discretionary income ranging between $25 and $200. So having $1,000 of discretionary income is not the moniker of what you need in order to be involved with the program. Remember, our average client is coming in with about $25 to $200 in discretionary income. This is your first look at the Money Max account program. What you're looking in the body here is the action plan. It always is set 3 months out and ahead, so you always know what's coming. And the top section there is called Our Dashboard. This is loaded with that $200,000 mortgage with a monthly payment of $1,199.10. and the $5,000 of income and the $4,000 of living expense. The program is telling John and Rebecca Jones that they will pay off all of their debt in 9.9 years. They will pay back $67,076 in total interest, and they have the potential to save $164,600 in total interest. Now, if that was your situation, would you be excited? This line item right here with the two little red arrows is called a funds transfer. This is the teeth of the Money Max account program, and it is telling our client to take $6,387.93 from our home equity line of credit and pay it to our first mortgage. It is just that simple. The Money Max account program does not move money. It does not pay bills. You have to perform the actions that it's telling you to do in real time. So let's take a look at how this comes together. Month one, if we added $6,387 in month one to our payment, let's see what happens in month two. Well, remember how I said that The amortization schedule is linked principal and interest. Well, if we paid that amount of money to principal in month 2, we're actually going with a $31.94 principal jump. Remember, the principal contribution is only supposed to increase by $1 per month. We are now on actually payment 330 of our amortization schedule. By doing this, we cancel $29,215 of interest, and we eliminate 29 mortgage payments. So let's look at this on a balance sheet. We have our expenses of $4,000 that we're going to charge to our offset account. We have a funds transfer of $6,387.93 that gives us a new balance on our line of credit, our offset account of $10,387.93. We're going to make a payment with our income of $5,000. That gives us a new ending balance of $5,387.93. And for the use of the money that month, we are going to pay $44.90 in interest to our line of credit, giving us a new balance of $5,432.83. That cancels $29,215 of interest and eliminates 29 mortgage payments. We move into month 2 and we transfer the balance of $5,432.83. We have our expenses that we're going to charge to our line of credit of $4,000. That gives us a new balance on our line of credit of $9,432.83. We are going to apply our paycheck as a payment to the line of credit, giving us a new balance of $4,432.83. And for the use of the money that month, we're going to pay $36.94 in interest, giving us a new balance at the end of month 2 of $4,469.77. In month 3, we carry the balance of $4,469.77. We charge our $4,000 of living expenses to our line of credit. That gives us a new balance of $8,469.77. We're going to apply our paycheck as a payment to the line of credit, which gives us a new balance of $3,469.77. And for use of the money on the line of credit for that month, we're going to pay $28.91 in interest, giving us a new balance of $3,498.68. We move into month 4 and we carry the balance of $3,498.68. We charge our $4,000 of living expenses to the line of credit, giving us a new balance of $7,498.68. We apply our $5,000 of income. That gives us a new balance of $2,498.68. And the program in month 4 in this example tells us to perform another funds transfer in the amount of $4,231.62, giving us a new balance of $6,730.30. For the use of the money that month, we pay $56.09 in interest. That gives us a new balance of $6,786.39. Now, what I want you to see here is over a 3-month period, we have only paid $129 of interest on our line of credit. But during this 3-month period, we have canceled $45,666 of interest, and we've eliminated 46 monthly payments. Let's just move into month 7. Month 7 starts out with a balance of $4,874.90. We have our $4,000 of expenses, giving us a new balance of $8,874.90. We apply our income as a payment to the line of credit in the amount of $5,000. That gives us a new balance of $3,874.90. We are asked to perform another funds transfer in month 7 in the amount of $3,911.04. That gives us a new ending balance of $7,785.94. And for the use of the money that month, we spend $64.88, and that gives us a new balance of $7,850.82. Over the full 7-month period, we have paid $320 in interest on our line of credit as an offset account. But look at what we've done. We have canceled $59,153 of interest, and we've eliminated 61 mortgage payments. That's 5 years and 1 month of mortgage payment, and we did all of this by investing $320.23 in interest on our line of credit. Month 5, we were at payment 309. Month 6, our amortization put us at payment 308. Month 7, we're on payment 292 with a balance of $183,796. Moving into month 8, we will experience another principal jump from the funds transfer on month 7, and that's another principal jump of $20.86. Over that entire 8-month period, we have experienced a principal jump of $81.02. Remember, that is only supposed to go up $1 per month. We did this in an 8-month period. We've canceled $59,153 of interest, and we've eliminated 61 mortgage payments by utilizing this process and the Money Max account program. Our dashboard for our client at the top now reveals that our client will be totally debt-free in 9.3 years. The interest remaining is only $60,424, and they have the potential to save $164,600 and have already saved $59,153 off the back end of the loan. And if you notice here, the program is telling our client, John and Rebecca Jones, to do another funds transfer in the amount of $2,934.30. So how do we compare to conventional means? Well, we both have a $200,000 mortgage. In 7 months on a conventional mortgage, if you made every payment on time, you would be at a balance of $198,585. With the Money Max account program in 7 months, we have a balance of $183,796. It would take you 5.7 years of making regular payments on your conventional mortgage to reach a balance of $183,922. With the conventional plan, you still have 30 years to pay. With the Money Max account program, you have 9.9 years. Conventionally, you'll pay back $231,677. With the Money Max account program, potentially you'll pay back $67,077. So the question begs that you have to choose one or the other. Do you like 9.9 years to pay off your debt or 30 years? And I think that's a pretty simple question to ask. All of us would like 9.9 years and saving potentially $164,600 and removing 20 years of mortgage payments. I want you to just stop and think for a moment. What could you do with 20 years of mortgage payments? And the answer is really quite simple. Anything you want. The Money Max account program does not need a home equity line. It does not need a personal line, does not need a commercial line, does not need a secured line or a credit card, although it will function in that capacity. It now works just as effectively with a checking and savings account. So let's look at how the money operates with the checking and savings account. We have our checking, our savings account. It's just in reverse of what we're doing with the line of credit. A payment comes in. Program analyzes the amount of money that came in and generates a funds transfer us, pay money to savings to make a deposit. We get another paycheck in. The program analyzes that amount of money and tells us to move that money over to make a payment to our savings account. The program now says we have the optimum amount of money in our savings account. It generates a funds transfer, looks at all of our debts individually and simultaneously, and tells us to pay the money here. Our program is backed by science. We are the first interactive debt elimination program on the market today. We connect over 13,000 banks, lenders, and credit unions. We are web-based for connectivity and security. This also has a great benefit to you in that lifetime program updates are at no charge, and you don't have to worry about, do you have enough memory to load a disk? Since we are web-based, as we improve the product, as we expand the program, all of your updates, all of the updates that we give on the program are all overnight and automatic. You pay no additional fee. We are mathematical engines driven by complex banking algorithms and systems. There is no magic. With us, it is just mathematics. Currently, we offer live client support, live chat, live training, online video tutorials, online blog, and continuing education for the life of the program. Our corporate commitment is over $19 million in R&D costs to date, but I believe the results speak for themselves. The questions you have to be asking yourself now are, how many families need our message and our product? Do you want to be the emissary for life change in your life, in your family's life, in other people's lives? How many families do you want to help? How many families do you believe need to be helped? How many people would you talk to about this program? But again, I say results speak for themselves. To date, we've helped our clients pay off $2,038 million in principal. Now, that is not including interest saved. That is not including money that's been freed up for them to invest for their retirement, potentially second homes, summer homes, investment properties. $2,038 million of principal reduction from United Financial Freedom and the Money Max account program. We are on a mission, and we are all working together as a team to convert America's debt into wealth and to buy America back one family at a time. Achieving your goals begins with debt elimination. Ask the UFF agent that invited you to this presentation to run your free savings report. The savings report is free of charge and no obligation. Let the numbers do the talking for you. Don't delay. Do it today. Get with the individual that invited you to the program. Have them run your free savings report. The only thing you have to lose is time and massive interest. You know, many times what we're looking for is right in front of our face, and the FedEx logo has an arrow in that logo. Many people don't know it. Well, many of you didn't know the concepts and everything that I'm taking you through today in this presentation. So what I'm going to do is point out the arrow in the FedEx logo. There it is. Now you've seen it, and I promise you, every time you see the FedEx logo, you're going to say, there's the arrow. My hope at the end of this presentation today is that we have pointed the arrow out to you, that we have pointed your way to financial freedom and reduction of the amount of massive interest that we are charged on our debts, and put you on a journey to financial freedom and converting your debt into wealth. Thank you for joining us.